Welcome back, traders and investors, to Benzinga's Pre-Market Prep, brought to you by MarketFi. I'm your co-host, Joel Elconin, along with Brianna Valesky, and we have Curtis Erickson on the line. He is CEO of Erickson Wealth and Tax Management, based out there in Seattle. How you doing, Curtis?
I'm doing well. Happy holidays, everybody.
No, thank you. Same to you. And okay, so let's tell us about Erickson Wealth and Tax Management a little bit. I see that you're dealing a little bit of real estate, small businesses, how to improve their financial future. You're a certified tax coach and a no commission RIA. Let me talk about your role first as a no commission IRA.
Okay. Well, so I've been a CPA tax planner for about 26 years, and all along my clients were asking for financial planning advice. And so about 1998, I became a registered investment advisory, which doesn't mean you can't accept commissions, but my earlier training with the broker dealers that charge commission, I just became uncomfortable because you would charge generally a huge upfront commission, and then that was it, and then maybe get a little bit of what they call a trail fee. So early on in my career, I said, this doesn't feel right, and it feels like there's a conflict of interest, and so I became fee only. And what that means is that I can help people with their financial planning on just an hourly fee basis, or if they would like assistance in managing their wealth, we just charge a flat fee for assets under management.
Okay, all right, and obviously RIA you can't provide, you can't receive any incentive fees, but seems like you went the RIA route long before it was in vogue. So congratulations on that. And you also
Okay.
said that you charge on an hourly basis too. Then, huh? That's I think that's an interesting concept. What kind of business do you generate from that?
Well, it's interesting. I do better on the hourly rate for our younger investors. These are the people that maybe are working here in Seattle. We're kind of in a little mini tech boom. We have our
Mm-hmm.
headquarters for Amazon.com is here. There's also, of course, Starbucks and Microsoft, and Google has an office here now. And a lot of the younger people that are coming into the area, they get involved with their stock option compensation plans, or they have maybe a 401k type retirement plan, and that isn't conducive for me to manage, for a percentage fee under management anyway. So they like coming in knowing that I'm objective, and then I'll just charge an hourly rate. And I'm not afraid to state what my hourly rate is. It's $200 per hour, and they come in, and we might meet only for a half hour or an hour. They might just have some specific questions, and they're happy to pay the fee and know that they got objective advice.
Oh no, that's interesting. That's a creative way, and you're right because that stock options and management. Isn't there a little company named Microsoft? Isn't that out there too, or is that in
That's
Seattle?
correct. Yeah,
Yeah,
not so little anymore, but yeah, it's called the mature company.
yeah. No, it surely is. So, also, so it seems like you're working as a CPA is kind of been a boon to being in the markets. As an RIA, you can also provide tax advice. Do you do the taxes for a lot of your clients as well that you do advising for?
Yes, that's the two areas I focus on: taxes and the financial planning. And so, my current estimate is about 90% of my total client base I do the tax work for also, and the other 10% they might either still like to do their own taxes, or they might have another CPA that they like to work with. But
Mm-hmm.
so I would say yes, about 90% I do the tax work for.
Okay. All right. And so let's talk about taxes here. Winding down towards the end of the year, do you have any tips? I mean, I'm sure some people are sitting on some nice profits and don't foresee any changes in the tax structure, at least coming up in the upcoming year. Do you have any words of advice for traders slash investors for the upcoming 2014 tax deadline?
You're right; it's coming up very quickly. So starting last year, there was the Affordable Health Care Act surtax that was charged to all investors, and so on top of the normal either short-term or long-term capital gain tax rate, there's an added a surtax that could be as high as 3.8% more, depending on earnings, and so that added a tax burden to every investor. And just a really quick review of the basic classifications. Most traders that I've worked with in the past, they tend to buy and sell more rapidly throughout the year. So most of their gains are often what they call short-term gains, and then of course that would be taxed at the highest marginal rate that the combined income that investor and their family have. So it could range anywhere from 10% up to 39.6%, depending on how profitable they were in the current year. And then, of course, there's the long-term capital gains, and this is for holdings that are held for greater than 12 months. And those typically have a capital gain rate of 15%, plus that surtax I just mentioned earlier on. So there is an incentive to try to match capital losses with capital gains, because no matter what your tax bracket is, any losses that you realize can directly offset any gains that you have already realized earlier in the year or through the end of this year. So that's an incentive. However, there are some complications with the wash sale rules, meaning that you don't want to just sell that security and then let's say rebuy it the next day, because typically there's a 30-day wash rule that you can't rebuy that security. So I always tell people, even though I have a strong tax background, that never sell things that you think are good investments just for the sake of taxes. Make sure that you're looking purely at the investment return before any kind of tax considerations.
I see you also have some experience in the real estate market, and what do you recommend a portion of person's assets? Let's just say someone has $1 million net worth. Do you recommend any kind of specific allocation to the real estate market?
Great question. Many of my clients do live here in the Seattle, Washington area. However, I do have clients in other parts of the country. But what I have found is here in Seattle, we have a relatively vibrant real estate market. And so the average median house price has already gone up to back to 2007 levels, before we had our last real estate crash. So typically, if a person is buying their own residence, and then maybe they have maybe one rental property, that typically is plenty of real estate allocation, in my opinion. In my investment portfolios, we don't specifically buy any real estate trusts or any kind of real estate funds, because most people that I work with already have a fairly good exposure to real estate because of the housing prices here. That being said, I've seen standard allocations of maybe 5% of your portfolio net worth to real estate, but it's different for every person. And I don't want to draw out this conversation, so I hate to give a blanket answer.
Right. No, I know. And I mean, the one thing too about, real estate, I mean, is, it's not really liquid. If if you buy a shopping center, you're an investor in something like that, there's, if something goes wrong, there's really not a bid to hit to be able to not
Right.
liquidity. And so that's one thing that, you have to keep in mind. You've written a couple books here. Do you want to tell us about the books? Investor Awareness Guide. That's an audio CD. The 7 Deadly Traps and 3 Power Strategies. You're quite the author too.
Well, yeah, thank you. I want to give some credit to my co-author, Mark Matson, and Mark Matson is my what I call my co-advisor, and he has developed the funds that we use in our clients' investment portfolios. But the books don't talk about specific investments to buy. What they do talk about is how to invest prudently using an academic approach. This may sound contrarian to a lot of your trader clients on the call today, but we purposely avoid picking stocks, and we use classical asset allocation, and based on efficient frontier, way back to Harry Markowitz from the University of Chicago, and all the way up to Professor Eugene Fama, who won the Nobel Prize in economics this past year. And we use global asset index funds in 42 different countries, and we weight the portfolio portfolios to smaller companies and value companies. And without getting too technical, we have academic research to show that those are the asset classes that make a difference in providing portfolio returns in excess of like the S&P 500. So those are talked about in the books that tapes that we have put together, and also about discipline. Discipline, I think, is the biggest problem most investors have. Is they tend to bail when the markets are in turmoil, and they tend to then they wait to buy in when the markets are at a higher price.
Okay. And so what are you feeling? What are you telling your people now that, coming up on the end of the year, markets at all-time highs, kind of had a strange market really over the last couple months, that correction, the Ebola-induced correction in October. People thought we rebounded quickly from that. And then you had I was off last week, but you had the quick dip and the rip your face off rally again. What do you tell? You telling your clients that be a little cautious here at these levels, or you expect the bull just to plow right into 2015 and continue?
Great question, Joe. I never even try to predict what's going to happen in the market like today, this morning, but what we do is we constantly rebalance portfolios. So what's interesting about this rally is it's principally been in the U.S. large growth market. So the U.S. large growth and large value had really great banner years, but small companies in the U.S. and small value, and also most of the international indexes have taken a much lower rate of return for this year. So what we're actually doing is we're taking the U.S. large asset categories that have done really well and taking some off the table, and we're rebalancing them into the asset classes that haven't done as well, and rebalancing across the globe. And so you can actually get a lot of the international indexes pretty cheap right now. So that's what we're doing.
Do you keep any black swan protection or any some puts that you're just going to expire worthless? Do you keep any kind of portfolio insurance?
No, I know a lot of people have had success doing that. We want to capture full market returns. What we do to manage and mitigate risk is we use short-term treasuries to mitigate the risk. And so what happens is that depending on a person's comfort with risk, and that's a lot of what I spend my time doing is helping the client determine what their really comfort of risk is. We might have some clients that only have 5%, in the short-term treasuries, but we might have some clients that have as much as 75% in U.S. treasuries. So that's how we mitigate the volatility with using short-term fixed income.
Just going to cash then, basically.
Well, yeah, we always keep a static allocation. So what happens is let's say somebody's after going through the analysis, they say, okay, I want to be 50-50 in cash and 50% in global equities, and we're always constantly rebalancing. So like in this current market where equities have really risen, we'll continually take some off the table and replow them back into fixed income. And then when there's that inevitable correction, we'll take the excess fixed income and rebuy the equities as they're cheaper again.
So I got a good strategy. How about any of these oil stocks catching your fancy here? They've been, were you caught holding any of them this big decline, or are you looking to perhaps, do some asset allocation to some of the big oil stocks, perhaps looking for a rebound?
Great question. The nice thing that's freeing about our philosophy is we don't have to pick individual stocks or really even in individual sectors. But what we do is and I don't know it's for a fact. I have to study it right now currently, but we're about ready to do our next rebalancing here at the year end. And I guess this is because of the big decline in oil prices. A lot of the big oil companies and some of the players in the oil industry are becoming what's called value companies. Those are distressed, high book asset, low stock price stocks. And so those typically have shown about a 3% premium over the long term over growth stocks. And so we're going to, I'm sure, rebalance and invest in those. But that'll be as one of our 19,000 securities that we have in our global asset allocation funds. And
you love to play golf. What's your handicap?
Well, I started really late in life. I was a basketball player growing up, so I picked the game up in my 30s. I'm about a 12.
Well, that's not too bad. You'd only have to give me like 8 or 10 strokes if we played. And you're a
The thing I
classic.
remember is it rains here in Seattle a lot, so we can't play all year round like a lot of other places.
You can play more than we can play in Detroit. I guarantee you that. Classic film buff. Give me your 3 favorite classic films.
Oh, okay, great question. Well, going back from the old days, I'm a huge Alfred Hitchcock fan, so just about any Alfred Hitchcock movie I would say is on there. I do have a really soft spot for Wizard of Oz, just the innovation with the way they went from black and white to color. Really love that movie. And then I'm a huge James Bond fan, so I own every version of every James Bond movie. Little trivia for your guests: the very first James Bond film was actually the U.S. made in 1957 called Casino Royale. And it was an actor named Barry Nelson was hired, and it was made for TV movie, and that was about an hour and 10 minutes long. But that's the very first James Bond movie.
Yeah, and I got a little tidbit on James Bond, Sean Connery. I'm not sure what